Hello everyone, welcome to this session. In this session, we will be discussing on the computation of tax liability. Well, by now we all would have an idea regarding how the different heads of income are being computed for an individual. Once the income of an individual has been assessed under the 5 heads, which are salary, house property, business income, capital gains, income from other sources, the next task is to identify or find out or compute the tax liability, that is the tax amount which has to be paid by an assessee to the tax or as an income tax which has to be paid. Basically, when we talk about the methods of taxation, we have 2 different methods in practice. One is the step system, the other one is the slab system. So in case of step system, the tax rate increases as the total income increase. That is, the person with lower income should pay a lower tax, and it goes in a higher order. When the income increases, the tax rate also will increase. Actually, the system has been discontinued in India after 31st March 1939. Now, we are following the slab rate system or the slab system. This system is most reasonable one, justifiable one and equitable one. Reason: the assessee's income is divided in different slabs. Different slab rates are prescribed for. Different rates are prescribed for different slabs. Now let us understand what are the different slabs. When we talk about the income tax slab, we have like 2 regime which is being there. One is the old regime, the other one is the new tax regime. Both are still in practice. It is up to the assessee to decide upon which regime he has to choose, that is, which slab rate system the assessee wants to choose. In case the assessee opts to take up the existing slab, that is the old tax regime, the slab rate or the tax will be applicable as follows. Up to 2,50,000 of his income or her income, the tax liability is nil. Any income between 2,50,000 and 5 lakh will attract 5% of tax. The next 5 lakh income will attract 20% of the tax, and the balance, that is anything above 10 lakh of income, will be charged at 30%. Here we all know that there is a rebate that has been applicable under section 87E, which was introduced in 4 financial years back. So that is the rebate under section 87E, wherein it is a standard of 12,500 rupees can be claimed or is been allowed to be claimed by the assessee whose annual income or the taxable income is less than 5 lakh. And in case anything is being left over beyond this 12,500, then in that case it will be charged for cess. That is, any income of tax beyond 12,500, if it is being left over, at the rate of 4% on that will attract or will be charged as health and education cess. In case of an assessee whose total income exceeds 50 lakh, there will be a surcharge on such income as well. Suppose the assessee wants to go for the new tax regime or the new slab rate. So in that case, this will be the slab. So which is being visible on your screen now. Up to 2,50,000, there is no tax, same as the old rate. From 2,50,000 to 5 lakh, it's 5%. Between 5 lakh to 7 lakh 50, it is 10%. 7 lakh 50 to 10 lakh, it is 15%, and thereby it goes on to 15 lakh and above, it will be 30%. You can also compare this with the old rate, which is given in the next column. One main difference between the old tax regime and the new tax regime is that there is no exemptions or deductions that are available under the new tax regime. Whatever has been the total income that has been there, it has to be charged for tax under the slab which has been applicable. Now, there might be a confusion which one to opt for. Either we should go for old tax or the new tax. Before that, let us just understand how the tax has been computed. We know we take the income under the head salary, we compute income under the head house property, we compute the income under head business or profession, which we call it as PBGP, we compute the income under the head capital gains and income under the other sources. All these together is called as a gross total income. From this, there are some common deductions which can be claimed. We know there are deductions which are applicable from under section 80, which starts from 80C to 80U, but they are listed out one are some common exemptions that can be claimed under section 80. So deduction under section 80C is related to savings which fall like PF, LIC, tuition fees, PPF, etc. 80D is with regarding to mediclaim. 80E, that is for education, that is higher studies loan that has been paid. Then 80G is with regarding to donation. Then we have 80TTA and 80TTB. 80TTA or 80TTB only can be claimed. 80TTA is for all normal individuals. 80TTB is with regarding to senior citizens. Beyond this, there are also other deductions that can be claimed like 80GG with regarding to the rent paid, wherein no HRA has been received by the assessee. In that case, he can claim 80GG. So there are many such deductions. And after claiming all those deductions, whatever is left behind is called as total taxable income. With regard to salary computation, normally we start with gross salary, then from there we give standard deduction, and house rent allowance, whatever is there, that will be claimed. Then leave travel allowance or leave travel concession. Then we deduct professional tax and entertainment allowance, which are covered under section 16 of Income Tax Act. Then the total income is called as income under the head salary. Here the standard deduction is at the rate of is 50,000. Next comes house property income computation. In case of house property income computation, we have two heads. One is self-occupied, the other one is let out. In case of self-occupied house, the rent received will be nil, and therefore the NAV will have to be taking as nil. That is net asset value. From there we deduction under section 24, which is applicable for house property, and only deduction that can be claimed for self-occupied house is interest on loan. So therefore, in most of the cases, it will be resulting only in the loss. Not in most, all the cases where since there is nothing to deduct, there is NAV is taken as 0, the law will be always lost from self-occupied house. Whereas in case of let-out house property, the gross annual value will be computed, and from there municipal tax will be deducted. We get the net annual value. From net annual value, we go for deduction under section 24. There are two deductions that can be claimed under section 24 with regarding to house property. One, the standard deduction, which is 30% of NAV, and the number 2 is interest on loan that is being paid. Thereby we get income from house property. Next we have income from business or profession. So income from business will be done, and the following procedure will be followed. So from net profit we add all the inadmissible expenses. From there we deduct all the inadmissible income. Then we add all the admissible income. Then we less all the admissible expenses. Thereby we get our income from business. In case of profession, that is doctors, lawyer or chartered accountant, the three are considered as profession as per income tax. In that case, it will be like all the receipts will be added, all the payments will be deducted, which forms the income from profession. And we all next move on to calculation of capital gains, wherein we have two categories there. One is long term, the other one is short term. In case of long term capital gain, we start with calculating the gain from sale proceeds minus any expenses related to the sales. We get net consideration. From there we do the indexing process for acquisition and for improvement, and we deduct that money, and finally what we get is long term gain. In case of short term gain, we have the sale value less selling expenses, we get net consideration. From there we go to deduct cost of acquisition and cost of improvement, we get short term gain. The basic difference is that in case of long term assets, in case of land, plot or building, if it is less than 24 months, it is called as short term. More than 24 months, it is called as long term. All other assets, it is more than 36 months, called as long term. Less than 36 months, called as short term. So this is the basic difference between long term and short term. Then finally we compute income from other sources. So wherein it does not fall under any of the above headings. Those are the incomes like dividend, bank interest, winning from card games, horse race, etc. And in case of wherever applicable deductions are there, that could be claimed by the assessee. And finally we get income from other sources. So this is the way we compute our total income. From this we compute our total income, and then that is the gross total income we arrive at. And further we move on with calculating all our deductions under section 80, and wherever there is a set off and carry forward provision is available, there we provide, and finally we calculate the tax. Now, as we have discussed in the previously, that which one method will be most apt to choose. So there are two different methods. One is the new regime, the other one is the old regime. Old regime is in still practice, new regime is also in practice. It is up to the assessee, as we said, to choose between these methods. Here is a link which has been given for you, so wherein you can opt to find out which method will be more apt for the person to whom the tax has to be done. So there is a tax calculator which we get it, and we can this is a link that has been shared with you. So here you can use this tax calculator to find out which method will be best. Other than that, we also have an web portal from the income tax department as such, wherein we can get into that to find out which method will be more profitable regarding to the assessing. So here is the web link, and when we fill in the details with regarding to the assessment year, it's 21-22 which we follow for the current batch, and it is resident, and then we have as income. Say for instance, if it is like say 6 lakh rupees is total income in the previous year, then we can see that in case of the comparison, we can find in the old tax regime it will be 33,800, and in case of new tax regime it will be 23,400. Suppose let us change this 6 lakhs to maybe we'll say around 12 lakhs. Now let us check what will be the tax liability. So in case of old regime it will be 1,79,400, and in case of new regime it will be 1,19,600. Let us see what if the income is like say 5 lakh. So we know that up to 5 lakh they will not be paying any tax, since we have an exemption under section 87A, which is like up to 12,500. The individual may not have to pay tax. So if it is 5,50,000, then his tax liability will be 23,400 and 18,200. Now from this, you all could have noted that I haven't touched this column like total deduction. What is this total deduction column all about? In this total deduction, whatever is that grand deduction that is under section 80 is applicable. When we give that deduction, based on that the computation will happen. Say for instance, if the total deduction under section 80 all put together, it comes around say some 75,000. So in that case, when we can see which is now been more beneficial, you can see the old regime there is no tax at all, but whereas in case of new regime there is an 18,200 rupees tax, which was the same previously, because as we you could recall, as we told you when we were discussing on the slab, there is no deduction that can be claimed with regarding to the new tax regime. Hence, the broad conclusion can be that in case if there is no savings that is being made by an individual assessee, that is nothing he is going to claim, he or she is going to claim under section 80, in that case he can opt for or she can opt for new tax regime. In case if there is any deductions eligible to be claimed under section 80 by the assessee, in that case they can opt for the old tax regime. One important point to be noted here is, before opting for that, they will be giving an option in the income tax website that, or the employer will himself ask whether we are going to go for new tax regime or new old tax regime. Once it has been opted for that particular year, we cannot change in between that I am going to shift from old to new or new to old. If it has been opted in the beginning of year, it has to continue throughout. The next year only there is an option again to change from old to new or new to old. Hope you all had a better understanding of how the tax computation is happening. Thank you.